we're here to talk about, can trillion-dollar finance exist on public blockchain rails? And we have an amazing set of panelists here with us. So if I can get you all, please introduce yourselves in 15 seconds or less.
Hi, I'm Rena. I'm the president of the Canton Foundation. We're the largest Bitcoin layer 2.
Oh, wow, that was quick. Hi, I'm Tom. I spent most of my career at Jane Street. I was part of the team that started looking at crypto in 2017. Left in the beginning of 2025 so I can work in crypto full time. I spent a year at the Keone Foundation, which is a core Solana infrastructure provider, you guys know very well, and joined Qube, which is a global multi-asset investment manager. I joined there in February. Currently manages over 50 billion in assets, including over 2 billion in a dedicated digital asset fund called Mobius, helping to kind of start helping build out some of the external facing businesses.
Hey everyone, I'm Spencer Applebaum. I'm a general partner and co-head of venture at Multicoin Capital. Multicoin is a multi-billion-dollar asset manager with a venture business and a liquid fund, and all we do is crypto and blockchain investing.
Hello, great to be here. My name is Keone Hon, co-founder of Monad. Prior to Monad, I worked in the high-frequency trading space as a quant for about 10 years, led one of the trading teams at Jump Trading for 8 years, focused on futures trading, especially in CME, ICE, Eurex, and other major futures markets, and then launched Monad about 4 years ago. Monad is a bet that by building better rails for crypto and a much better system with better performance characteristics and with greater reliability, we can bring much of the activity that's currently off-chain on-chain.
Well, thanks, everyone. So I guess when we talk about trillion-dollar finance, what do we mean? Like, is it issued on-chain? Are we talking about TVL sitting idle on-chain, cleared volume, daily settlement, all of the above? Like, what are we talking about here from your perspective? I'll start with you, Rena.
I think it's the value creation on-chain. Whatever value that we've unlocked on-chain, what assets we've created on-chain, that should be all a part of the trillion-dollar finance. However much clearing and movement we can get, I think that's really what we're all kind of aiming for.
Yeah, I don't know. I'm old enough to remember when like $1 billion was a big number, and we now have individuals who are worth, close to $1 trillion. So I don't know. It feels like a somewhat arbitrary target, and we're all in this room because we think that the potential market opportunity is much, much, much higher than $1 trillion. I mean, you were Canton. You guys are doing 350 B a day in like repos.
Yeah, but we're here to talk about you, Thomas.
So I don't know.
Yeah.
I'm curious.
Yeah, I also think it's a moving target, and I also think it's kind of an arbitrary number. I will say at a meta level, total value locked in DeFi was one of the worst metrics that the industry ever came up with. I don't think idle capital is particularly useful.
Yeah.
So I guess if I had to answer, I would say some combination of settled, traded, and then in the context of payments sent. Yeah. But I do think just idle capital sitting on chain, not doing anything productive is not really the North Star for the industry.
Couldn't agree more.
I think that crypto is really a story about freedom and a story about open market access and basically creating a shared global layer where everyone has access to the best opportunities. So I think that the target for trillion-dollar finance is really a story about settlement volumes, trading, and the extent to which the trading world and all of the trading activity that currently exists off-chain has migrated on-chain, and it is thus in an environment where everyone has access to the same opportunities regardless of where they are.
Yeah, what you said about freedom really resonates, actually, because I think tokenization is solved. That's the easy part. But once you have a tokenized asset on chain, how do you put this to work for you? And I think that's pretty much the direction we're going in. So Keone, I'll stay with you, please. So you spent 8 years at Jump, with designing and building low latency systems where milliseconds count. And obviously, Monad does 10,000 TPS sub-second finality. So traditional exchange matching engines do orders of magnitude more than that. So is this relatively lower performance threshold even a consideration or a factor around unlocking, moving off-chain value on-chain, in your opinion?
Yeah, so a couple of things. I would say, first of all, we're just getting started in terms of the level of adoption and the movement of this trading activity that's off-chain, on-chain.
Yep.
And we're not at there's still so much more growth that's needed in order to hit the capacity constraints. And then when we hit those constraints, then we'll adapt and we'll make further improvements.
Yeah.
But I think right now there's already incredibly exciting momentum in terms of moving trading on chain. As one example, Purple is a new perpetuals order book DEX that is fully on chain. Every single submit, every single cancel is on chain, and their volumes are growing. They're up to about $300 million of volume over the past 7 days. And that's just, they just launched publicly about a month ago. So I just think that there's so much opportunity for growth and momentum. As we hit those limits, we will improve things further. But I think another thing to point out is that it's also, historically, we've been very limited by the capabilities of the blockchain themselves.
Yep.
And I think in particular, MEV is a massive issue. The fact that when you submit a transaction on chain, the fact that it's in a pending state, and anyone can see that and go front run it or sandwich it, is a massive, massive issue that needs to be addressed in order to unlock this bottleneck and thus bring much more activity on chain.
Yeah, that's a very good point you make around the MEV and so forth, because from what we're seeing at Canton Foundation at the moment is the narrative is switching away from the technology, and it's more so, I have this use case, what attributes do I need from whatever stack it is? So it's becoming more about finding that product market fit and actually making sure that your implementation is fit for purpose from a regulatory perspective, internal compliance, whatever it might be. So I think having been in the space for over a decade, I think it's definitely going the right direction now. We're getting back to sort of the fundamentals, if you will. So, question for you, Thomas. So you traded at Jane Street for 2 decades, and you're now sitting in a global multi-strategy investment manager. When firms like this look at public chains, what are the main reservations? Like Keone's already mentioned MEV, and front running. So is it positional transparency, where every competitor can see your book, settlement finality that you need your legal team to be able to stand behind, or is it something else?
Yeah. Yeah, it's a complicated question. Let me say a couple of things. The first is, when we look at market structure, comparing TradFi versus crypto, part of the reason why the traditional exchanges have such high capacity is because there's a single matching engine. And TradFi is oriented very clearly around this whole concept of price time priority. So whoever has the best price and gets there first gets to do the trade. And the reason why they can do that is because there's a single matching engine. And so a lot of the technology that has been developed over the last couple of decades within the trading industry, and you know this better than anybody, is oriented around this time dimension. There's colo, there's microwaves, there's radio waves, there's FPGAs, all of this stuff is designed because the system is deterministic in terms of the time. Now, in a distributed system, where the validator or the leader or the miner can be in Frankfurt in 1 second, and then the next second they're in Tokyo, the time dimension is much, much, much harder to manage. And so what I think is emerging in crypto is this idea that the primary deterministic element is price. And I think if you look at what has historically been called MEV, my old shop is trying to rebrand that as transaction order value, is the only dimension that will make your transactions deterministic is a higher price. And so you are willing to pay a certain amount for the trade, and then you're willing to pay a certain amount in order to get that trade to settle. And one weird element of that is that, if you send a market order in TradFi, what ends up happening is you get some sort of price improvement, and the price improvement goes to the user, right? Like you send a market order, you're trying to trade on Robinhood, and then you get filled mid-spread. But in crypto, historically, if you send a market order, you get filled at the worst possible price at your slippage parameter because some amount is in the trade and some amount is in the settlement. And I think that that's something that is very, very, very hard to fix. And at some point, we're going to need to figure out like how you kind of solve for time priority or add an extra dimension to price. The other thing that I'll mention is that I think a lot of the debate around public versus permission blockchains, I think revolves, at least from my standpoint, and this is overly simplistic, around the idea of privacy. Like, what does privacy mean? And I think on public blockchains, people are very comfortable with revealing the contents of their wallets as long as the ownership of the wallet is obfuscated. You don't know who owns the wallet, but you can look in and you can see all of the assets, you can see all the transactions. And so from a retail or individual perspective, privacy means privacy of ownership. Whereas for institutions, anybody who's had to file a 13F, anybody who has had to file like quarterly statements and reports and things like that, knows that for large asset managers, privacy of ownership is not really the issue, it's the privacy around transactions. Like you don't want to start deploying large size in a public way because then you can get front run, you can get your execution signature sniffed out, things like that. And so, so trying to figure out like where you sit on the spectrum and trying to build a more institutional marketplace will force public blockchains to think about what you guys do at Canton very, 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 very clearly. It's part of your mandate. So.
Well,
Yeah.
I think the takeaway there is build on Canton. Sorry, Keone.
I just want to say that the problem that Thomas is highlighting, I think, is actually the most crucial problem for our industry to solve, assuming that we believe that the single biggest value prop for crypto in the short and medium term is to deliver this universal asset layer and to deliver market access and just this open environment for asset ownership. If we believe that, then the single most important thing to solve is the MEV problem. And so I guess like I would suggest to everyone listening, like your teams should focus more on this. It's a huge problem, and it's not being worked on. Like I see it as a thing that people just kind of accept, like, oh yeah, MEV is a thing that we have in blockchains. There's no way around it because the leaders, it's like, we have leaders all around the world and it's moving around, and the leader has the ability to decide the ordering. And I think that that's a fundamentally flawed acceptance that we have made. And so at Monad, we actually have a solution to this. We published 2 papers over the past 2 months, and we're actively working to, it's already being worked on, the implementation is in progress, but we think this is the single most important problem to solve because MEV is the single biggest threat to this thesis of the shared universal asset layer.
Any thoughts, Rena?
I mean, I think I have like a different approach of like how I view kind of how we're going to get to $1 trillion and what's kind of the most fundamental issue. I do agree with that. I have a more like ethical or like social approach of I think we don't care enough about Bitcoin and like the Bitcoin network. And if we think about the past of 20 years of doing social networks and such, the platforms have been inverted of what Bitcoin created. We did trust without centralization, right? And we're now doing all of these different blockchain systems, all of these different chains and such, and we're bringing in decentralizations, governance and such, all of there. But none of us actually contribute to Bitcoin anymore in that way. I think if we don't continue to sustain the Bitcoin network, create the value creation on the Bitcoin network, everything for like tokenization or creating all of these trillions of dollars is not going to exist because we've lost sight of like what brought us here. So I'm more of the approach of I feel that there's almost like an ethical responsibility for us to like support Bitcoin mining, get the MEV approach from there, and then kind of take that to whatever like route that we take.
Thanks. So speaking of the public chain, Spencer, Multicoin's thesis has always been that open permissionless networks win because they compound developer activity, and with that, it brings liquidity to the network. So it can also be argued that the major institutional flows this year are actually going through permissioned hybrid network of networks like Canton, bank chains, regulated FMI pilots, and so forth. So is permissionless versus permissioned still an argument that's worth having, or should it even be part of the discussion? And then from your perspective, is permissionless winning the argument but losing the use cases, or is it a point or is it a spectrum?
Yeah, I'll answer that in a sec, but I want to touch on the privacy argument, which I guess kind of flows into this. And I'm probably going to get in trouble with our head of PR and communications because we're not supposed to talk about this in a public setting, but that's okay. Yesterday, so we published a research report on Hyperliquid a couple weeks ago, and our wallets have been doxxed basically since we own that token. And yesterday, we moved a lot of it because we were basically trying to undox our wallets. And basically, the entire market freaked out. I think I got 15 messages asking, "Oh, are you guys like selling your hype tokens a couple weeks after you publish a report on it?" And it's like, no, we're just moving our tokens around so that we continue to not be doxxed. And so I think this gets back to what Thomas was saying about this idea that institutions care about privacy specifically for their transactions. Like, we have no problem with people knowing that we have a lot. We will be public about how much hype we own. We really don't care. It's about people knowing like what we're doing with all of the assets that we own. And I think that's been one of the major challenges, I guess, coming back to the question for why institutions have struggled to use permissionless open systems. I think if you just think about crypto from first principles, it echoes a lot of what Keone said about open access to assets in a permissionless way globally. And I think it depends on the private chain configuration that we're talking about, and I don't think all private chains are homogeneous. Every different system is different. I do think, as a general statement, what I'll call corporate chains, like corporately managed chains, where there's a company, not to call out individual companies, but let's say a payment processor that launches a chain. I think it's going to be hard, because it's not credibly neutral, to get other payment processors to want to settle transactions on that chain. I think there is value in being credibly neutral, but I think all of the permissionless blockchains need to figure out, going back to what you were saying, is how can we build the features that institutions actually want to bring this on chain, whether it be privacy or KYC at the wallet layer, like whatever those features are that institutions need. I think permissionless chains need to do a better job of coordinating how to get them implemented. So to answer your question, I think both will exist. I think the stopgap right now is I like to call them corporate chains, but we'll call them hybrid permission chains for you. In long term, I think the vast majority of the value will accrue to the permissionless chains.
And quite frankly, even within Canton Network, we don't see it as a winner takes all, because at the end of the day, if we do our job right, then infrastructure becomes boring and reliable and taken for granted, right? You get online, you don't sit there worrying about, how Google.com is going to resolve, because DNS is just a thing, right? So we're getting there. And I think, one of the big focus areas for the Canton Foundation is actually building out that service layer partnerships piece, because it's not just about developers come and build, you need everything else that goes with it, right? So Rena, I got a question, speaking of, the public permissionless. It's a Bitcoin public chain asset that institutions already hold at scale, like plenty. But the interest appears to be more in the asset rather than the infrastructure side of things, the rails and what have you. So, you're betting that the Stacks ecosystem can turn Bitcoin into productive settlement infrastructure. So what appetite are you seeing from institutions to transact
Yeah, I think it's good to like separate out BTC, the asset, versus the network, right? Everyone cares about BTC, the asset. Not as many people care about BTC, the network. We take a different approach, but like I get where people are coming from. But we're kind of betting on the capitalist mindset, honestly. If people care about BTC, the asset, they're not going to want to just hold the asset. They're going to need to make it a productive asset, right? Everyone needs to make their spreads and such. So we're thinking about, can it be productive via DeFi? Can you yield on your Bitcoin? Can you use Bitcoin for economic security and stake and support other networks? I think that's really where we move as at least a Bitcoin-focused ecosystem, and that's really where Stacks is going. When I think about what Bitcoin is now from the network, we're already limited with no smart contracts or such as the Bitcoin network. So you're going to need other scalability layers. Stacks is one. There are others like Lightning and such out there too. But for an institutional standpoint, you're not just going to hold Bitcoin. You're either going to hold Bitcoin in Arbit, you're going to do the futures rate basis trade, you're going to DeFi, you're going to borrow against it. You're just trying to acquire more Bitcoin or more other assets that you're going to sell to get what you're trying to make your spreads. And so for us, it's really about providing utility and productive availability to Bitcoin. And for us, we do it through Bitcoin staking, where we offer a 3% targeted yield for providing economic security to the Stacks network, as we're L2 on Bitcoin through the Bitcoin value.
I think you make a really good point about productive assets because, like, as I said earlier on, tokenization's done. It's easy, that's solved. But how do you then put it to work?
Well, yeah, like everyone's going to care if number goes up for Bitcoin. Like every person in this room, that's what fundamentally our market is based on. But if we're not creating value for Bitcoin to increase in value, what's the point?
Yeah. And also, like, you could, as a retail investor, private citizen, and all that kind of thing, I could get part of my salary in USDC. Then I can convert that on a DEX into some other coin, stake it somewhere, earn some yield, put it to work properly. So, yeah. And Thomas, if I can flip that a little, so, Solana is arguably slightly the opposite. It's the chain with, where the majority of the transactions are, but not necessarily the assets held by institutions, Sol token and so forth. And most of that flow is crypto native, DeFi, depending on what label you want to put. Also, you advise GTO, which sits at the heart of it. So when you look at Solana from your vantage point, do you see the beginnings of institutional market structure at scale? And if not, what do you think is needed to get there?
So the simple answer is yes. But just to zoom out very, very, very quickly, like one of the amazing things about crypto is its ability to run experiments and iterate on those experiments on a global scale. And so if you think about where Solana comes from, it's like post-Ethereum, what are the things that are needed to scale to the next level blockchain? And so there's some explicit assumptions around blockchain space being valuable, the number of transactions, the speed, things like that. And then the key thing is going to be, well, how scalable is it on the basis of new needs, new use cases, things like that. And so where Solana goes from here is going to be a key question, a key determinant in whether or not it's successful. But I think if you look at TradFi, and I'm sorry I keep going back to TradFi. I know that we're trying to iterate a new financial system and all that, but if you look at TradFi, like there are different settlement systems for every different asset class. So you have CLS for FX, you have LPMCL for precious metals, you have DTCC for equities, you have OCC for options, et cetera, et cetera, et cetera. And that's setting aside like high throughput use cases such as payments and bank transfers and things like that. The idea that we can force all of this onto a single blockchain and that one blockchain is going to be fit for purpose is hard to believe. And for instance, let's just take payments for a second. Running payments through a blockchain where ordering is based on price priority is a really, really, really tricky problem because the point of payments is to have low fees and high throughput on these payments. You essentially need a dedicated payment rail or a payment lane, which is essentially what these kind of, the payment networks are trying to do. Because you can't add transaction costs on top of like high throughput payment flow. And so is Solana well positioned for RWA? Certainly tokenized trading, certainly. Is it going to be the solution to all settlement for all asset classes? I think that's a little bit unlikely.
Okay, so I realize we're coming up on time. We have 4 minutes, so I have a closing question that I want to put to all of you in any order. So 5 years from now, we're back here. It's 2031, and either $1 trillion, by whatever definition, of institutional value is on-chain, or it's not. And if it didn't happen, what do you think was the single most important factor, other than MEV?
I think it's trust, and I think the trust is downstream of security. Really, we've seen a huge number of hacks in the recent year or so that are related to private key compromise. So just like real simple, again, another thing to just take back with you is everyone should be using dedicated devices to sign their to do any signing for admin operations. This is like a simple improvement that was not doing that was the result of what caused the drift hack and caused many other hacks like that. So yeah, I think that if it's not, ultimately it's trust, and trust is downstream of fairness, but it's also downstream of security.
Spencer?
Yeah, I think it kind of goes back to what I was saying about the public permissionless chains, which I think is why a lot of us got involved in this industry in the first place, and it embodies a lot of what crypto is actually useful for. If the public chain foundations and teams don't prioritize building features that institutions need in order to start using their systems, I do think we're unfortunately going to be back here in 4 years or 5 years or whatever, talking about the same thing. So I really think it needs to be a big focus from the public chains to figure out what are all of the features that institutions want and need to use these systems, and then go and build them as fast as possible, which I do think we're already starting to see, which is great.
I think we're talking about a very, very thin left tail. I think it's highly likely that that this is not a scenario that we need to worry about. My guess is if it doesn't happen, it's maybe clarity causing people to withdraw CapEx, or maybe there's some trust issues or things like that. But I think, yeah, if we're not talking about this in we're going to get there.
We'll get there.
I think for me, it's like consolidation, that we have too many chains, too many apps, and everyone has their own ring fence. And like one way or another, there needs to be a convergence.
Yeah, agree. Standards, I think, are going to be key. And, Ethereum already did that with the ERC and what have you, and other chains have followed with their equivalent standards and interoperability and so forth. But I think discovery is also going to be a big one. To your point about trust, I think I heard a really good comment this morning. Most retail users are capitalist on the way up, but socialist on the way down. So I think getting the regulator involved and comfortable with both the technology and what it can do and what it stands for, I think is also going to be one of the key things that needs to happen before we get that scale. So thanks, everyone. And I want to thank my wonderful panelists for your time and your insights. And we'll speak to you soon.